Have you ever stopped to think about what really allows a company to grow, especially, responsibly and sustainably, particularly in a sector as vital as housing finance?
Mm,
It's definitely more than just looking at the quarterly numbers, isn't it? It's about, well, the deeper strategic choices they make and the impact those have.
exactly.
So today we're doing one of our deep dives. We're looking into the Q1 FY26 financial and operational performance of Home First Finance Company India Limited.
Right, BGFSC.
Yeah. And our mission here, as always, is to really pull out the most important insights from their latest releases, the reports, the investor presentations, all straight from the source.
Hmm.
We want to give you a really comprehensive understanding of their health, their growth drivers, and where they're headed strategically.
And what's fascinating here, I think, is that this isn't just going to be us reading out figures.
No, definitely not.
It's really about understanding the story behind the numbers. How a company that focuses on affordable housing is navigating pretty significant growth, how they're using technology, and, importantly, the social impact they're making.
Yeah, that social impact piece is key.
We'll look at how they connect with their customers in perhaps a unique way, how they manage risks so carefully, and how they're building that solid financial base for the future.
Absolutely. So, okay, let's jump right into those headline numbers. This is for the quarter ended June 30th, 2025.
Right.
And the board approved these results just recently on Friday, July 25, 2025. First off, the profit after tax, PAT, it really stands out, 119 crore.
Wow, yeah.
That's a pretty remarkable 35.5% jump year over year.
35.5%.
Yeah, and also up 13.6% compared to the previous quarter.
Okay, strong growth there. And what about the top line? Total income?
Good question. Total income hit 455 crore,
455. Okay.
which is also showing strong growth, 33.4% year over year and 9.4% quarter over quarter.
Got it. And they also reported profit before tax, PBT, right?
They did. PBT was 1,564.97 million. And their PPOP, the profit before provisions and operating expenses that came in at 168 crore,
Right.
that's up a healthy 41.3% year over year. And just quickly, basic earnings per share was 11.69.
1169. Okay. So those are definitely some impressive headline figures.
They are, but the question is always sustainability, isn't it? How sustainable are margins like that, especially that strong PP growth, given the segment they're in? What do the underlying profitability ratios tell us?
That's a crucial point. And the ratios really do seem to back up their strategic strength.
Okay.
So return on assets, ROA, was 3.7% in Q1 FY26. That's actually up 10 basis points year over year.
An improvement. Okay.
An improvement, yeah. Return on equity, ROE, was 14.9%. And they also mentioned a pre-money adjusted ROE, which was even higher at 16.6%.
Right.
But here's, I think, where it gets particularly interesting. Their cost-to-income ratio. It came in at 34.2%.
34.2. That seems low for this sector.
It is. And it's a very positive trend. It's down 140 basis points year over year
Wow.
and 150 basis points just since the last quarter.
Okay.
So in a sector that, is often known for high operational costs because the underwriting is so granular, getting a cost-to-income ratio that low and seeing it improve, well, it points to real efficiency.
Right. It suggests strong operational leverage.
Exactly. It suggests they're scaling effectively, probably because of their business model and tech adoption, without costs rising proportionally. That's a significant advantage, sort of a competitive moat.
Okay. Yeah, that cost structure context is really helpful. So let's shift gears a bit. Let's talk about the engine of the business, the loan book itself. How's that growing?
Mm-hmm.
Their assets under management, AUM, reached 13,479 crore in Q1 FY26.
13,479 crore.
Okay. Which is, again, robust growth, 28.6% year over year.
Right, strong quarter.
6.0% quarter-on-quarter growth. Now, disbursements were 12,243 crore. There was a slight dip there compared to Q4, about a knack at 2.3%, but still up 7.0% year over year.
Got it. Still positive on the year.
Still positive year over year, yeah. And crucially, their focus remains firmly on housing loans. That's 83% of their AUM.
Right, core business.
And their target segment. Around 61% of their customers fall into the EWS LIG categories, economically weaker section or low income group.
Mm-hmm.
And it's a very granular book. The average ticket size is about 1.18 million. So Small loans, essentially.
Yeah, very granular. And what's really fascinating, picking up on that, is how they manage this growth by specifically targeting a segment that, let's face it, traditional lenders often find difficult or overlook.
You're true.
Their customer profile is pretty balanced,
Hmm.
68% salaried, 32% self-employed.
Yeah.
But here's the real insight, I think. 14% of their customers are new to credit.
14%. So first time accessing formal credit.
Exactly. First time. Imagine, maybe a skilled welder, right?
Hmm.
Earns a steady income, but maybe doesn't have the standard pay stubs.
Right, or maybe someone running a small garment business from home.
Precisely. Home First Finance seems to have built a system not just to give them a loan, but to actually assess their total income, including those informal sources.
Which is something legacy lenders often struggle with.
They really do. So this ability to sort of de-risk and actually validate the earning potential of a segment that others might see as high risk, well, that seems to be their unique edge.
It effectively expands the market for housing finance.
It really does.
Yeah.
And they back this up with, practical things like 48-hour approval times, no prepayment charges, digital access to documents. It makes the whole process much more accessible for first-time buyers.
Yeah, that's a really vital service, bringing potentially excluded people into the formal financial system.
Mm,
But okay, with growth, especially in this kind of segment, the question of asset quality always comes up. How are they managing the quality of this loan portfolio?
right, the risk management side.
Yeah, we saw their gross stage 3, that's a gross NPAs, was 1.8% in Q1 FY26. That was up slightly, about 10 basis points from the previous quarter.
Okay, a small uptick.
And early delinquencies also ticked up a bit. The 1+ DPD loans, just 1 day past due, that was 5.4%, and 30+ DPD at 3.5%.
Right.
Both showing, slight increases quarter over quarter.
Right, 90 BPs and 50 BPs up, respectively.
Exactly. Their credit cost for the quarter, though, was 40 basis points, which they said is in line with their guidance of 30-40 BPs.
Okay, so if we connect this to the bigger picture, despite those slight movements in early delinquencies, the company really points to its underwriting framework as the key to managing asset quality.
The data science approach you mentioned.
Exactly. It's data science-backed, it's centralized. They're apparently using over 100 data points.
Wow.
And they integrate APIs with third-party sources. They mention Hunter and Perfio specifically.
Right. Those are specialized credit and fraud detection platforms.
They are. They give much deeper insights into an applicant's financial behavior than just standard checks. And this is combined with their own proprietary machine learning models and customer scoring.
So it allows them to make more informed decisions, even with those non-traditional income profiles.
That seems to be the idea. It's a tech-led approach to mitigating risk in this specific segment. Plus, they have other safeguards built in, like relatively low exposure to under-construction properties, about 55%,
Okay.
and a low loan-to-value ratio when they originate the loan, 47.3% on average.
Right. So there's a good equity cushion?
Exactly. And their operational indicators, like collection sufficiency, that was still high at 97.0% in June 2025. And the bounce rate for July was 15.8%, which suggests they're managing the post-disbursement phase effectively too.
Okay, that strong tech backbone really does sound like a critical differentiator for managing risk with their customer base. Let's move on to the company's financial foundation, capital, and liquidity.
Sure.
They recently had a very successful QIP qualified institutions placement, didn't they? Raised quite a bit.
So they did. 1,250 crore.
Yeah, significant amount. And that boosted their net worth by 1,231 crore up to 3,855 crore as of June 2025.
A substantial boost.
And perhaps just as importantly, their long-term credit rating got an upgrade. AA stable now from ICRA, India Ratings, and CARE. That's a big validation.
Absolutely. A AA stable rating is a strong endorsement.
And their capital adequacy looks very comfortable. Total CRR at 49.6%, and Tier AC capital also very high at 49.2%. Huge buffers there.
Yeah, those capital levels are very strong. And that capital infusion and the rating upgrade are, well, they're crucial for ensuring that long-term stability and, importantly, their access to funds, especially for a company aiming for continued growth.
Right. How are they managing their funding?
Well, what's strategic here is how diversified they are. They have relationships with 33 different lending partners.
33. Okay.
And significantly, they have zero borrowing through commercial papers. That seems quite prudent in the current market.
Yes, definitely avoids short-term rollover risk.
Right. Their actual cost of borrowings was stable quarter on quarter at 8.4%. And they maintain a pretty hefty liquidity buffer, 3,379 crore as of June.
Okay, good cushion.
Yeah. And their asset liability management, the ALM profile, looks well managed too. They report positive cumulative flows across all time buckets, which basically means they have funds matched well against their obligations.
And they also use loan transfers, right? Direct assignments and co-lending.
They do, it's part of their strategy.
Right.
They mentioned direct assignment of loans, selling parts of the loan book, about 2,043 million instruments worth in Q1,
Yeah.
and they have active co-lending partnerships with big names like Central Bank of India, Axis Bank, Union Bank of India.
So a multi-pronged approach to funding.
Exactly. Diversified ensures they have the financial muscle to keep growing while managing their balance sheet risk.
Makes sense. Okay, let's look beyond the pure financials for a moment. Let's dive into the operational side and some of these strategic initiatives driving this performance.
Okay.
Their distribution network keeps growing. They're up to 158 branches now, added 3 new physical branches this quarter. They're now present in 142 districts across 13 states and union territories, and their total touch points are up to 362.
So expanding their physical reach as well.
They are. And their employee base has grown too, up to 1,709 people. Added 75 net new employees during the quarter, but I think where they really seem to be pushing the envelope is technology.
Yes, that seems to be a core theme.
Absolutely. They've integrated DigiLocker for secure document verification. They launched something called Pulse.
Ah, yes, the conversational AI.
Right, an omni-channel conversational AI platform. Apparently, it can converse in 7 Indian languages.
7 languages, why?
Yeah, they use it for lead generation and customer service. And their general digital adoption rates are incredibly high.
Like what?
Well, 78% adoption of account aggregators for new approvals.
Okay, that's high. Facilitates data sharing.
Exactly. And over 80% digital fulfillment, so digital agreements, e-NACH mandates for repayments.
Very paperless.
Very. And it shows in customer behavior. 96% of customers are registered on their app, and 88% of all service requests are actually raised through the app.
That's impressive adoption.
It is. And they even mention having proprietary in-house applications for things like document management and treasury management. So tech is clearly central.
Which raises an important question. How does all this operational strength and tech focus connect with their broader commitments? ESG, environmental, social, governance, and their overall long-term value creation plan.
Good point. How are they integrating ESG?
Well, on the environmental front, it seems quite tangible. They're actively promoting energy-efficient green homes, certified 70 new ones this quarter, bringing the total to 190.
Okay.
And those paperless processes you just mentioned, 84% digital agreements, 67% e-stamping, 81% e-NACH. That's not just efficiency.
No.
It directly reduces their environmental footprint.
Right. Less paper, less travel, maybe.
Exactly. And then socially, they have initiatives under Project Sashakt.
Ah, yes, I saw that mentioned. What does that involve?
It focuses on community development, things like skilling programs, education support, health initiatives, financial literacy drives, and they provide examples. Beneficiaries like Ria getting skills for a job, or Varsha benefiting from health workshops. It seems quite focused on making a tangible difference in the communities they serve.
Which likely builds trust and loyalty, too.
You'd imagine so. And their core business itself has a strong social angle, right? 61% of their AUM is with EWS-like customers.
Financial inclusion in action.
Precisely. And an impressive stat, 89% of their loans have a woman as either the primary borrower or a co-borrower.
89%.
Yeah, which often correlates with better repayment discipline, by the way. And they've also helped a lot of people, over 38,000 customers, access the PMA government housing subsidy. That's nearly ₹1 billion in subsidies facilitated.
Wow. Okay, so E&S seem well covered. What about the G governance?
Governance looks robust, too. They highlight a diverse board. 5 out of 7 directors are independent.
Good independence level.
And 2 out of 7 are women directors. Plus, they emphasize their clean track record. No defaults on borrowings, no qualifications from auditors, no financial restatements.
All signs of strong governance practices.
Exactly. And their MD and CEO, Manoj Viswanthan, summed it up well in their commentary, didn't he?
Yeah.
He talked about their commitment to building a large, affordable housing finance franchise driven by our unique business model.
Right.
It really feels like they see this as building something sustainable and impactful,
Yeah.
not just hitting quarterly numbers.
Yeah. What an incredible deep dive that was into Home First Finance. I mean, we've really seen a clear picture emerge, haven't we?
I think so.
You've got the strong financial performance, definitely. But then there's the strategic growth in that specific, often underserved, affordable housing segment.
Mm-hmm.
Add to that the robust risk management, heavily leaning on that innovative technology backbone we
Right,
discussed.
the tech piece is central.
And then layered on top, or maybe woven through it all, is this deep, seemingly genuine commitment to ESG principles.
Yeah, it feels integrated.
It does. So, looking at all this, drawing directly from their own source materials, you really get a comprehensive, sort of nuanced picture of how they operate and where they're trying to go.
So what does this all mean? Maybe for you, the listener. Here's something to think about.
Yep.
How does a company's ability to seamlessly blend advanced technology, a really granular, almost empathetic understanding of its diverse customer base, and a strong commitment to sustainable, inclusive practices?
Hmm.
How does that ultimately create value?
And not just financial value, I mean.
Exactly. Not just financial value, but potentially lasting societal impact, especially in a market as vital and rapidly growing as housing finance in India.
Right.
Maybe think about how those different factors, tech, customer understanding, sustainability, how they might interact and really shape the future of this whole sector, moving it perhaps beyond just lending money to something more transformative.
A very interesting thought to end on. Food for thought indeed.